Bruce Udell. Our third and final speaker has made me literally tons of money just by knowing him, listening to him and learning from him. Well, wait until you hear his ideas on annuities, life insurance, tax planning, estate and business ideas. Make sure you keep your pencil sharp. He's nothing less than outrageous, yet his ideas are totally 100% transferable. He will make you money tonight after this conference if you really want to pay attention. He's 45 years old. He's in the business 22 years, just about half his life. He joined the top of the table at age 36, one of the youngest members ever, and he's the one and only Bruce Udell of Orlando, Florida.
So listen up, here it comes. I'm going to give you three ideas that combine life insurance and immediate annuities that will achieve a remarkable estate planning result for your older affluent clients. So let's talk about the first one. The first one involves tax-free bonds. Now, if you work with older clients, you will find that most of them who are affluent, have a significant amount of assets, and have liquid assets, have a substantial portion of those liquid assets in tax-free bonds. And they love those bonds. They think they're the greatest thing since sliced bread. Why? Because the income from those tax-free bonds is tax-free. So my conversation with that type of a client starts like this. I'll say, Mr. Client, I noticed that a significant portion of your estate's invested in tax-free bonds. Why is that? And he'll say, well, because the income from it is tax-free. And I'll say, right. In other words, you can get more income from your tax-free bonds than you could from, let's say, the after-tax equivalent of a taxable investment. He'll say, right. And I'll say, well, you know, your tax-free bonds aren't really tax-free. And I usually show him at that point the cartoon that it's on page 46 in your handout, in your notebook. And of course, you can see there's a fella coming down the street with a gleeful look on his face holding his tax-free bond, which he loves because the income's tax-free. And around the corner is Uncle Sam, and Uncle Sam's got the old big estate tax axe, and it's about to chop about half that tax-free bond off. And I'll say, you know, when you die, the assets that you have invested in tax-free bonds are less than half of those assets are going to go to your family. More than half of those assets are going to go to the government. Now, would you buy a tax-free bond that has a $1,000 par value and matures at $500? I mean, I've heard of buying bonds at a premium, but that's ridiculous. And I'd say, do you know why tax-free bonds are taxable in your estate? The reason they're taxable in your estate is because you can sell those bonds tomorrow and you can use the assets to purchase a new home, to take a vacation, to buy a yacht. You have the right to get current economic enjoyment from the principal that's invested in those tax-free bonds. And therefore, the government taxes it in your estate. But let's assume just for the moment that the government came out with a new type of tax-free bond. And here's the way it worked. You could keep all of the income from that tax-free bond as long as you live, just like you can from your tax-free bonds now. But you can't touch the principal in that tax-free bond during your lifetime. It's tied up. And in return for your agreeing not to touch the principal in that tax-free bond, the government will agree not to tax it in your estate for estate tax purposes. So your family will get 100 cents on the dollar instead of 50 cents or less on the dollar. Mr. Client, would you buy some of those tax-free bonds? And if so, if he says yes, how much would you buy? Most clients will say yes. You have to remember, most clients are not spending their principal. And you know, they never will. Because if they spend 100% of their principal, they'd be broke. So we all know that they're going to have some amount of principal in their estate when they die. The only question is, where should it be? So let's just take a look at a comparison between what we call the totally tax-free plan and your tax-free bonds. Tax-free bonds provide tax-free income. The totally tax-free plan provides an after-tax equivalent that's similar to what he would get from tax-free bonds. Tax-free bonds, the principal in tax-free bonds tax-free bonds is subject to call provisions. The government can call a tax-free bond if they want, right? And refund it if interest rates go down because it's cheaper for them. Totally tax-free plan, they can never do that, okay? Also, the principal in tax-free bonds can fluctuate in value. The totally tax-free plan, the principal can't fluctuate in value, although you can't touch the principal during your lifetime. The tax-free bonds that you own are subject to any creditor claims that you may now have or later have. The totally tax-free plan is exempt from any creditor claims. And as I mentioned earlier, your tax-free bonds are taxable in your estate. So at your death, the government will get more than half of the money that you have in tax-free bonds, and your family will get less. The totally tax-free plan is completely free of all estate taxes. Let's take a look at an example. Let's assume we have a 72-year-old male that has $1 million worth of tax-free bonds. And what we're going to suggest he does is sell those tax-free bonds and invest most of the money into an immediate annuity. Now, an immediate annuity, just to refresh your memory, is a contract with an insurance company where you give them a lump sum of money up front. They promise you an income for as long as you live. And it's considerably higher. The income you get is considerably higher than tax-free bonds. The after-tax income shown here in a 31% tax bracket is $118,420. Now, right at that point, I'm probably going to stop and ask the client, what do you think about that? That's 11.8% tax-free bond at a time when you can only get 6. He's going to say to me, that's ridiculous. How can they do that? I'm going to say, well, there's one catch to this tax-free bond. He says, what's that? I say, well, when you die, there's nothing left. So theoretically, you could live 1 year, get one payment, you die, the principal's gone. How do you feel about that? Whatever he says, that's going to tell me something about that client, right? I mean, I'm going to learn something about that client. He's telling me, I don't care about my kids. He might say, yeah, okay, fine. So I get all this income, that's all I care about. But most likely he won't. He'll say, geez, I don't like that. I want my family to get some money. That's why I built this estate. And I'll say, fine, then let's adjust it a little bit. Let's take $46,000 a year from that tax-free bond income. Let's gift it to a life insurance policy, a life insurance trust outside of your estate. It'll buy a $1 million life insurance policy on your life. And when you die, $1 million will be paid to your heirs, completely income and estate tax-free. Now, we've spent $46,000, still leaves you $71,000 after taxes. That's about almost 7.2% in our example. Mr. Client, that's a pretty competitive tax-free bond, isn't it? But instead of your heirs getting 50 cents on the dollar, they're going to get 100 cents on the dollar. That's how the conversation kind of goes with the client. There's another alternative, another adjustment to this. It's a variation of this approach, and we use it with people who are rated for life insurance. Now, I'm sure a lot of you have had clients who are rated for life insurance. And one of the problems with placing a rated policy is they don't really think they're as sick as the insurance company does. So every client thinks he's healthier than what the insurance company thinks he is. And so they don't really want to pay the extra premium. And I'll say to the client, geez, you know, you don't really like this insurance policy. You don't like the fact that you're rated, do you? And he says, no. He says, I don't think the insurance company knows what they're talking about. I said, well, you know, the reason they rate you is because they don't think you're going to live as long as the normal person. He says, right, that's what I don't like about it. I don't think they understand. I ride the treadmill every day, and I go to the doctor twice a year, and I'm not the average guy. I take care of myself. I say, well, how would you like to beat the insurance company at their own game? He says, what do you mean by that? I say, well, there's another type of contract that insurance companies issue, and they look better if they don't think you're going to live very long. He says, what's that? He says, it's called an immediate annuity. You give the life insurance company a lump sum of money up front, and they guarantee you an income for as long as you're going to live. And if you're not going to live as long, they can pay you a higher income. Now, there are a number of companies in the United States and in Canada that issue these type of annuities. And what we did in the particular example that's in your notebook is that we said we invested $1 million, just like we did. It's the same as the other plan that we just looked at, except now the income from this annuity, this is a 76-year-old male, is $175,000 a year. And again, I'll say to him, that's 17.5%. And he's going to say, how can you do that? Just like he did before. And I'm going to tell him how it works. And then he's going to say, well, I don't like that. I want my family to get something. And when he says that, I'm going to say, great, let's take $88,000. That's it. Remember that life insurance premium you didn't like, the $88,000 because you thought it was too high? Right. Well, let's pay that anyway. Let's gift it to a trust outside of your estate, buy the $1 million policy, and look what happens. You still have $87,000 left to spend or invest any way you like. That's an 8.7% return per year. And when you die, your family, instead of getting 50 cents on the dollar, will get 100 cents on the dollar. What do you think about that? And then we have a comparison between our tax-free bonds and the tax-free bond alternative, which we show all the time, which compares side by side. Here's your tax-free bonds. Here's our totally tax-free plan. Which one would you pick? There's a third type of plan which we use with people who have highly appreciated assets. Okay? And a lot of people recommend charitable remainder trust. We recommend something called a charitable gift annuity, very similar to what we've just talked about. And let's assume that on page 60 in your handout, we have a person who has $1 million worth of highly appreciated assets with almost no basis. Zero basis is what I've assumed here. Could be stock in his business, but it could be a highly appreciated stock in a private company that went public. There's a lot of ways you can get assets that have very little basis. And they don't sell these assets because they don't want to pay the capital gains tax and only have a certain amount left to invest afterward. So even though they might get a higher return on some other asset, they'll have less assets to invest after capital gains taxes. If you look at this, we have $1 million of assets. If he sells the asset outright, he'll have $327,600 worth of capital gains tax to pay. So the net amount that they'll have to invest is $672,000 a year. Okay? If that person invested the $672,000 a year at 5.5% after taxes, they'd have an after-tax income of $36,982, and theoretically they could keep that for as long as they live. Now, when they die, they could leave the assets to the spouse, and the spouse will continue to get $36,982 a year for as long as he or she lived, but at the second death, there's going to be an estate tax on those assets of $336,200, and the net amount to the family is going to be $336,200, assuming the 50% estate tax bracket. Not very good. That's about 33% of the original amount they started with. Doesn't make the client very happy. I said, let me show you an alternative to that. Let's assume you took the $1 million, and I'm now on page 61 in your outline, and you gifted that property to a charity. And the charity, in return for you giving them that property, promised you an annuity as long as you live. And that annuity, in this case, happens to be $95,832 a year. Now, you've never paid any tax on these assets, and so that annuity is taxable. And you'll have to pay each year $33,149 a year in tax, leaving you a net after-tax payment on the annuity of $62,683. How does the charity get the money to sell you the annuity? Well, the charity sells the $1 million of property you gave them. They're a tax-exempt organization. They don't have to pay any tax on that, so they have $1 million to invest. They take $900,000 of that $1 million, and they use it to purchase the annuity, which coincidentally happens to be $95,832 a year. They keep $100,000 to use however they want, but often they'll let you direct how that money ultimately gets used. And you get a tax deduction for $237,298. Now, there's only one problem with this, same problem we had with the other two plans. When the second spouse dies, it's a joint and survivor annuity. When the second spouse dies, there's nothing left. So the client's children lost about $336,000. So usually they don't like that, and what we do is we plug in on page 62 our wealth replacement module. And we say, look, why don't you take $24,000 a year for the first 7 years and gift it to a trust outside of your estate, and we'll use that money to buy an insurance policy on your life for $850,000. So when you die, your family gets $850,000 after taxes. That's a lot more than the $336,000 they were going to get if they just if you sold the property outright and invested it. So they get $850,000. You only pay the $24,101 for 7 years based on current assumptions. Could be longer than that. Could be longer than that. If interest rates go down, might be shorter if interest rates someday go up. But right now, based on projections, it's $24,000. But after the end of that 7 years, your family gets, the policy is now paid for, your family gets $62,682. Even if you had to wait 10 years to get that, over your life expectancy, your family gets a lot more money. And if you happen to die tomorrow, your family get $850,000 instead of $336,000. Now, and the charity gets $100,000. Now, where would you use this? Well, obviously with appreciated assets. A lot of people say, why wouldn't I just use a charitable remainder trust to sell the assets? Several reasons. Number one, most of the time, as I mentioned, when you put money in a charitable remainder trust, the client doesn't want just all the assets to go to charity. Okay? They want to replace the wealth for their family. They want their family to get something. And if you get an older client, that insurance premium's high. And it takes all the income from the charitable remainder trust just to pay the premium on the life insurance policy. Well, if he didn't want any income for his lifetime, he'd just give the property to the charity and forget about it. That's not why they're setting up the charitable remainder trust. So if you get somebody who is unhealthy so the premium's high, or they're older so the premium's high, a charitable gift annuity increases the income if you get a rated annuity. You can't increase the income from a charitable remainder trust because somebody's not healthy or because they're older. So those are situations where you would use a charitable gift annuity instead of a charitable remainder trust. I'm actually going to combine some business planning with some estate planning here. And we're going to talk about split dollar, which will be interesting today in light of the recent TAM that came out. But I had a client who needed $5 million of ordinary life insurance. That's what he needed. He knew he needed $5 million of ordinary life insurance. He had a very successful S corporation. And in fact, he had $5 million of life insurance. He was just buying term insurance at the time. Why was he buying term insurance? He didn't want to use all of his annual exclusions to pay premiums on a life insurance policy. In fact, he was using his annual exclusions to gift bank stock, highly appreciated bank stock that paid about a 2.5% dividend to his children each year, instead of using them to buy a life insurance policy. That's why he was buying term insurance. I suggested to him, I said, why don't you, instead of doing what you're doing, recapitalize the stock of your S corporation into voting and non-voting shares. Now, you can do that with an S corporation. You can't have different classes of stock, but you can have voting and non-voting stock. And I said, why don't you start making gifts of your non-voting stock in your S corporation to a trust outside your estate, which would be a grantor trust. And he said, well, why should I do that? I said, well, there's a couple reasons. Number one, if you make gifts of a minority interest in your S corporation, you can get a discount on those gifts. And a reasonable discount today would be somewhere between, let's say, 30 and 40%. It could be higher, but let's just assume that the discount you would get would be about a 33 1/3%. That makes my arithmetic easy, which means that if you gift $15,000 worth of S corporation stock to your trust, you only have to use $10,000 of annual exclusions because you get a 33% discount. So $15,000 is worth 10. So now we're getting more property out of your estate because of the discounts. Then, in addition to having gotten the stock out of your estate, which, by the way, is growing a lot faster than the bank stock at this point in time, any income on that stock via the S corporation distributions would automatically flow to your children or to the trust for the benefit of your children. So now your trust has income. And therefore, your children will have income each year which will accrue outside of your estate. Now that the trust has income, I said, why don't we enter into a split dollar life insurance agreement? Let's set up a permanent life insurance policy for $5 million instead of the term policy. And let's enter into a split dollar agreement with your trust. And each year, you'll make contributions to the trust equal to what the economic value of the death benefit is each year that the trust is receiving. Your corporation will pay the difference. We're talking about a $5 million policy here. The annual premium is $50,000 a year. It's payable for about 15 years. And so each year you'll make gifts to the trust of just the PS58 cost each year. If we look at page 71 in your outline or on the screen, you'll see that in year one, the premium is $50,000. The stock value, I'm sorry, not the premium, the annual gift is $50,000 of stock. Now, he gifted $50,000. He only had to use $33,000 of his annual exemptions to do that, okay? And he has 2 children, so they have $40,000 a year they can give away annually. So he's giving $50,000 of stock, which he gets a 33% discount, so he only used $33,000 of annual exclusions to do that. The stock value at the end of the first year, we're assuming that the stock increases in value each year by 10%, the actual value of the stock. And we're also assuming that the S corporation will pay about 20% of the value, the appraised value of the stock each year as income, which is not unusual in closely held corporations. Okay, so at the end of year one, it's $55,000. The before tax income is 0, because I assumed by the time we got this all set up, there would be no income flowing to the trust in year one. I was being conservative. But in year 6, he's now gone 6 years on this. He's gifted $50,000 worth of stock each year. The stock value inside the trust is up to $424,000. The before tax income for that year alone is $67,156. In year 7, we look at, again, the annual gift is $50,000. The stock value is now $521,794. The before tax income is $84,000, okay? And And at that year, we roll out the policy. We roll out the policy. If we look at the trust, if we look at age 45, the after-tax income in year 1 is 0. Okay. The withdrawals are 0. The income account is 0. The total value is $55,000. In year 6, the after-tax income is $48,352 now from the S-Corp. This is income that's flowing to the trust via the S-Corp stock. The withdrawals are still 0. The income account is now up to $153,661, and the total value in the account, if you add the stock value and the income account together, is $578,000. Year 7, we roll the policy out. So we make a withdrawal in year 7. The after-tax income is now $61,000. By the way, I'm showing this even though this is a grantor trust, which means that the income would really be taxed back to him. He would pay the tax on it. One of the things that the CPA said is, well, what if we did this with just the kids without the trust? What's the effect of that? And that's why I was being conservative and actually showing tax on the income. Actually, this proposal, assuming you really went with the grantor trust, would be even better because since he pays the tax on the income in a grantor trust, that's an additional gift to the kids. That's an additional value that accrues to them, which doesn't use any annual exclusions. But I was being conservative, so I'm still paying tax and still showing them, even if they have to pay tax on this, because they decide to do it without the trust or with the children, it still works. In year 7, I take a withdrawal of $203,000 out of the trust. I have my income account is still at $12,214. What do I do with the withdrawal? Well, what I did is I rolled the policy out for its cash value, and I had enough money to pay the premium that year of $50,000. And from then on, that trust will always have enough money from the S distributions, assuming they continue, to pay the premiums on the policy. So we roll it out. Now the corporation's completely out of the deal. The trust has the policy. And if you look at what happens with the insurance, at the insurance policy level, in year 1, again on page 71, in year 1, at age 45, you can see the PS58 costs us $3,220 for a $5 million policy. If we skip down to year 7, we're done. We rolled it out, okay? And if you look at the total, we have used, over that 7-year period, $23,000 of annual exclusions to pay a $50,000 premium. Okay, to get a policy, a $5 million policy with a $50,000 premium out of the estate. That's all we used. 1/2 of 1 year's premium to get the $5 million policy out of the estate. So we solved his problem. He can buy a $5 million permanent contract. He doesn't have to pay. He doesn't have to use many of his annual exclusions to get it, way less than he was going to be using with term insurance. And he got $5 million out of his estate. You know, I made my living for 15 years in the retirement plan business. That is the qualified retirement plan business. I started a company that designed, installed, and administered over 400 qualified pension profit-sharing plans back in 1976 or so, and I sold that company a couple years ago. As an old qualified plan guy, I have to tell you, I still think that in the right situation, qualified retirement plans are a great way to accumulate money for retirement. They're just not the only way, and in a lot of cases, they're not the proper way. But let's just take a look for a moment at qualified retirement plans from a historical perspective. When I started doing qualified retirement plans, they were a great deal. And you should be on page 81 in your outline. The contributions to the plan were deductible by the employer. The contributions were not taxable to the employee, and the investment earnings on the plan accumulated tax deferred. When you took the money out, you could elect favorable lump sum 10-year averaging and significantly reduce the income tax you had to pay on lump sum distributions. And under the old law, when I started doing plans, in addition to all these great benefits, the benefits paid to the heirs could be estate tax free. You could accumulate $1 million, $5 million in your qualified retirement plan, and they'd be estate tax free. Then we had a number of tax reforms, which I've listed starting in 1976, almost every year from 1976 to 1993. And although qualified retirement plans are still a good deal, they're not a great deal. They're not as good a deal as they used to be. Contributions are still deductible by the employer. Contributions are still not taxable to the employee. The investment earnings still accrue tax deferred. But now, You don't have 10-year forward averaging anymore. You just have regular 5-year averaging. There's more restrictions on participation and vesting. Their benefits are now taxable to the estate, 100% taxable to the estate. Excise taxes could be applied. They can apply if you take out too little, too late. They can apply if you take out too much, too soon. And even if you do everything right, you still might be forced into paying an excise tax. Because if you accumulate a lot of money in a qualified plan, it's very possible that the minimum distribution that you're forced to take out at age 70 and a half without an excise tax of 50% is greater than the maximum distribution that you're allowed to take out without an excise tax. So even if you do everything right, you may have to pay an excise tax. You have a success tax, as we know, if you accumulate too much money in your qualified plan at death. Okay? And they're obviously more expensive to administer. Also, because of the artificial restrictions that the government placed on how much you can contribute to a qualified plan, in a lot of cases, and how large the benefits you can take out in case of a defined benefit plan, in a lot of cases, the benefits that you can accrue in a qualified plan are not enough to fund retirement, particularly for affluent people. So let's take a look at page 86 and look at an example of what I'm talking about. Let's look at a 45-year-old who's going to retire at age 65, and let's assume they can earn 8% on their earnings while they're in the plan. And let's assume an inflation rate of 4%. We're also going to assume a salary is $250,000, and we're going to assume this person would like to retire on 70% of their salary immediately before retirement. So we're going to assume their salary is going to increase every year at 4%, and they're going to want to retire on 70% of that. That's just a rule of thumb in the retirement planning business, that how much money you're going to need when you retire, because one of the things you don't need at retirement is to save more money for retirement. So you need less money, generally speaking, than you were making immediately before that. Well, this person, if we look at our example, which is on page 86, okay. Also, one more assumption. Let's assume that they have $250,000 already accumulated in this plan. So they started at age 45, and their salary is $250,000. You can see that. They're going to save $30,000 that year. The fund's $302,000. By age 55, the salary is now up to $370,000. They're allowed to put $44,000 into the plan that year. The fund has now grown to $1,224,000. By age 65, when they want to start taking benefits, it's grown to $3,419,000, and he wants to retire. This person wants to retire on 70% of the before-tax earnings. Of their earnings immediately before retirement. That comes to about $383,000 a year, $383,000, which will increase each year. On page 87, you can see that by age 77, this person's out of money. They ran out of money. So, did they need to accumulate more money for retirement? Yeah, I hope they're saving money someplace else than just that qualified plan, unless they plan to die by age 77, or else they're going to be in for a big surprise. If we look at another example on page 89, all I did is say, what if this person wants to retire at age 60? A lot of my clients, particularly professionals, now are looking towards early retirement ages. They don't want to go to 65 anymore. You ask them when they want to retire, they're not looking at age 65 necessarily. So look at age 60, and you can see, assuming the same assumptions, same salary, salary grows by the same amount. Look at age 60. They've accumulated $2,056,000 in the retirement plan. They're going to start taking out $315,000 a year, which is 70% of their salary at that time. Okay, and by age 68, they're out of money. 68. 8 years. So they better be putting some money aside someplace else besides just a retirement plan. But just for the moment, let's assume that we have a person and they want to compare, because a lot of times qualified retirement plans not only aren't enough, they're not the right answer. Okay? And let's look at page 92. Page 92, we're going to start looking at a comparison between a qualified retirement plan and a non-qualified plan. We're going to make some assumptions. We're going to assume that this person would be willing to put $20,000 into a non-qualified retirement plan. And they would earn 7% on the money, accumulate on the money. If they put that $20,000 into an insurance policy, the insurance policy we were using projected that they would be able to take out a retirement benefit of $58,946 a year after tax. We're going to borrow the money out of the plan. If this person were to put in a qualified plan, we're assuming that they could design a plan where 90% of the contribution to the tax-deductible qualified plan would go to the owner, and only 10% would go to the employees, and they could get this plan administered at $1,000 a year. Pretty nice assumptions, actually. We're also going to assume that the tax bracket's 40% and that he's going to retire at age 65. The corporate tax bracket's 40%, individual tax bracket's 39.6%. He's 45 years old, going to retire at age 65. Well, in order for that person, if you look at age 45, the first year, in order for that person to put $20,000 into an insurance policy, he's got to earn, at the corporate level, $33,113, which they'll then bonus out to the person. He'll pay $13,000 of tax, and guess what? Of $20,000 to put away into the plan. If we look at by age 64, the person's accumulated $759,426. That's actually at the end of age 64, so really beginning at age 65. By age 65, he's accumulated $759,000. On page, you can see, at page 65, he then starts taking out a benefit, after-tax, non-qualified benefit of $58,946 from the insurance policy at 65. He can continue to do that from 65 to 95, at which point he basically runs out of money. There's $1,000 left. You can see on page 93, there's $1,000 left. If you look at the qualified plan side, which is on the right-hand side of that page, you can see at age 45, if he takes the $33,000 that he needed in corporate earnings, in order to have $20,000 left to put it into a non-qualified plan. If he uses that to fund a qualified plan, it's all tax deductible, except 10% of that money goes to fund the cost of the other employees, and $1,000 is the cost of administration. So considering that, there's now $28,801 to put away for him in his qualified retirement plan. And if he accumulates that over at 7% till age 65, he will have, you can see on page 92, he'll have $1,263,375 accumulated in his qualified retirement plan. Now, starting at age 65, in order for him to have a $58,946 after-tax benefit to spend like he has from the non-qualified plan, he's got to take out of his qualified plan $97,593 because now, you accumulate money tax-free, tax-deferred in the qualified plan, but when you take it out, right, it's all taxable. So he's got to take out $97,000 a year. If he does that, he can do that continually until age 92. You can see on page 93, at age 92, he's out of money. He's out of money. So, and he had no death benefit either, which he did have a death benefit from the qualified plan, non-qualified plan of about $1 million in this case, okay? So was he better off with a non-qualified or a qualified? You might get a discussion from a CPA on that because it looks pretty close in this example, okay? Now, let's take a look at page 95. We're going to assume that instead of 10% of the cost going to the employees, he now has to give 20% of the cost to the employees. 80% is still going for him, but you can't design quite as good a plan, so 20% is going to go to the employees. If you look at that example, really, the non-qualified side is the same. So just let's look at the right-hand side of that page, which is the qualified plan side. If 20% is going to the employees, that means that only $25,490 is going to his account. By age 65, he will have accumulated $1,118,000. And by age 65, he can take out, he starts taking out $97,000 again, because that's what he needs to take out to get to the $58,946. But on page 96, you can see that he runs out of money at age 85. So again, unless he plans to live to age 80, die before age 85, he's better off with a non-qualified plan, because the non-qualified plan goes to 95 for the same amount of money. If we look at one more example, which is on page 98, you can see that if we go to 30%, meaning only 70% now goes to him, 30% is going to the employees, the cash value, he now can only put away $22,000 goes to his account out of the at $33,000 of before tax earnings. And of course, you see on page 99 then, he runs out of money at age 80. Now, one of the things I want to point out about these plans, when you sell a non-qualified plan and you put it into an insurance policy, and that guy gets his first year's statement for cash value, what does it show on it? It shows, it looks lousy, right? You're going to get a phone call. He's going to call you and say, "What did you do to me? I thought you said this is a good plan." Remember one thing, retirement Savings for retirement is long-term. It's a long-term issue. It's not just a long-term issue because you're going to age 65, from 45 to 65. This guy's likely to live to age 85. So we're not talking about 20 years, right? We're talking 40 years here. So it's a long-term issue. One thing you'll find, and I tell all clients this, and I point to the first year. When I sell a non-qualified plan, I go to that first year and I show him zero cash value in that first year. Look, and I tell him, I said, if you cash this in the first 5 years, this is the worst investment you'll ever make. And if you keep this until retirement, you'll kiss me on both cheeks because this will be the best investment you ever make. And I say that probably 4 or 5 times in that meeting. And I say, but you know what? Name one good long-term investment that's also a good short-term investment. Real estate? No, I don't think so. Common stocks? Maybe not in 1987. Name one good long-term investment that's also a good short-term investment. Good long-term investments make lousy short-term investments. Great short-term investments make lousy long-term investments. About the only thing that you can go into is a money market fund and try to make any money on that long-term to enable you to accumulate money for retirement. It won't work. But I point it out to them all the time because otherwise when that guy gets that statement the first year, okay, he's going to call you up and he's going to, I just had an interview the other night. I went with the client. Client calls me up. I'd gone through all this with him a year before. He says, Bruce, there's no cash value in this policy. I thought this was a great deal. And I said, remember when we went through this? And he said, I know. It's a great long-term investment, lousy short-term investment. I said, remember, I said, if you're going to cash this in 5 years, don't do it. Don't go into it to begin with. So I wanted to point that out to you. Now let's assume that the person is a good candidate for a qualified plan, and now they want to examine some non-qualified alternatives. Okay? Well, if we take a look at someone who's in a, and I'm in page 107 in your book, look at someone in a 39.6% tax bracket, again, age 45, he's going to retire at age 65, and we're going to earn 7% on the earnings. And what I've done is I've compared non-qualified alternatives. Should he put it in an insurance policy? Should he put it in something else? I showed $20,000 a year going in. He's going to take out an after-tax benefit of $58,946, just like we did before. And he's out of money. If he starts making money out at age 65, he is out of money. You can see by age 64, there's $284,000 in the account. He's out of money by age 78. And the insurance policy will go to age 95. So the issue is, there are definitely appropriate times to use an insurance policy to fund retirement benefits. Sometimes it's better than a qualified plan. Often, even if a qualified plan is good, he needs that in addition because he's not going to have enough money in his qualified plan to be able to retire. But make sure that you caveat it. If you point out that it's a great long-term investment, lousy short-term investment, you will have happy clients.